We're all used to tracking prices. Whether you're watching the cost of flights for a vacation, eyeing concert tickets, or checking a stock, you've probably used a standard line graph to see if the price is heading up or down. But a line graph has a major limitation. It's like looking at the final score of a basketball game. It tells you who won the day, but it hides all the lead changes, the momentum shifts, and the drama that happened on the court. To understand the market, we have to see what's actually happening, a continuous tug of war. On one side, buyers are pulling to push prices higher. On the other, sellers are pulling to drag them down. To see that hidden battle, we need to move past the standard line graph and look through a different lens. Take a look at a single data point on a normal line graph. It's just a dot. It tells you where the price ended, but it doesn't show you how the price got there. Watch what happens when we expand that dot to show the entire day's price range. The point stretches vertically, forming a thick rectangular center with thin lines poking out of the top and bottom. Turning that dot into a candlestick reveals exactly how that day's struggle played out from start to finish. Let's look at the parts of this new shape. The thick central block, called the real body. Its top and bottom edges show exactly where the price sat at the opening bell and where it landed at the closing bell. When the buyers win the day, the closing price finishes higher than the opening price. The top edge finishes above the bottom, and the box turns green to mark that victory. If the sellers win the day, we see the opposite. The price is dragged down, meaning the closing bell was lower than the opening bell. In this case, the box turns red. By checking the color and size of this real body, you can immediately see which team controlled the majority of the session. Now, let's focus on those thin lines sticking out of the top and bottom. These are called shadows or wicks. Think of these shadows as the muddy footprints left behind on the field. They show the extreme limits of the battle, the spots where one team managed to drag the other before they lost that ground. A lower shadow forms when sellers pull the price down to a temporary low, but buyers rally and drag it back up. An upper shadow shows buyers pushing to a high peak before sellers fiercely pull it back down. These lines serve as physical evidence of the day's back and forth swings, marking how much ground each side managed to grab before losing it again. While the body shows the final score, these shadows reveal the intensity and the struggle that took place before the closing bell rang. Now, let's use what you've learned to interpret a specific scenario on a chart. Take a look at this shape, a tiny green body and a long bottom shadow. That shadow shows sellers dragging the price into a deep plunge, but the green body reveals buyers fought back to erase the drop and steal the win. By looking at the relationship between that small body and the long shadow, you've decoded what happened in this specific trading session. Because it looks like it's striking back against a drop, traders call this pattern the hammer. The hammer is just one piece of evidence, but when you see these shapes appear one after another, you can start to see larger patterns in how the market is moving. Each candle on this chart captures a moment where buyers and sellers fought for control, revealing the constant human tug-of-war behind every price change.